Something in Washington is shifting. At first, like a faint ripple and then like a tidal wave no one can stop. It doesn't come with explosions or cyber attacks flashing across TV screens. It's quieter, hidden, and far more dangerous. Beneath the US economy, pressure has been building, invisible to most, but flashing like a warning light to anyone watching the bond markets. The shock didn't start with weapons or armies, it started with numbers. Treasury yields edged higher, barely noticed, then suddenly vaulted past 4 and 5%. For everyday Americans, those figures meant little. But inside global finance, alarms blared. Investors began retreating. Treasury auctions were skipped. What was once the safest investment in the world was turning toxic. Wall Street filled with fear. Phones rang non-stop. Trading floors pulsed with panic. Rumors multiplied faster than facts. This wasn't theory anymore. This was infection. Then Washington flinched. No speeches, no fanfare, no rollout. Just a quiet about-face. Overnight tariffs on Chinese imports vanished. Electronics, auto parts, industrial machinery. For an administration that once prided itself on standing firm against Beijing, the move looked like surrender. Officials told the public it was an effort to curb inflation. But insiders whispered the real reason. A Treasury auction days earlier collapsed with foreign demand down nearly 30%, while the 10-year yield was shooting toward levels that had toppled regional banks the year before. Behind closed doors, Treasury Secretary Scott Bessent urgently phoned Chinese officials. No transcript, no press release, just desperation. Within hours, tariffs were gone. Markets noticed instantly. It wasn't strategy, it was fear. "It smells like panic," said JP Morgan's Phoebe White. And in finance, panic always outruns policy. The warning signs weren't just from China. In February, Japan, America's closest financial partner, dumped $36.6 billion in US debt, the biggest monthly sell-off in more than a decade. This wasn't posturing, it was survival. With its central bank ending yield curve controls, Japan's institutions scrambled to stabilize domestic markets. Selling treasuries was the only move they had left. The system wasn't trembling anymore, it was convulsing. Goldman Sachs analysts pointed to the core problem, debt service. With the national debt past $36.2 trillion, each 1% rise in rates now adds $346 billion in costs every year. The math itself had turned lethal. The Congressional Budget Office quietly revised its forecasts. Interest expenses would soon outstrip defense spending. In just the first quarter, Washington spent $273 billion servicing debt, more than Medicaid. The foundation was buckling. Inside BlackRock, traders raised red flags. If yields broke above 5%, the Fed would be forced to intervene, pumping liquidity into collapsing banks, saving the system, but risking the dollar's credibility. Inflation could, roar back. That sudden tariff reversal wasn't a bold maneuver, it was emergency treatment, an attempt to slow the bleeding and buy a little time. But time itself is running short. The Federal Reserve now faces a brutal crossroads. Raise rates to defend the dollar, crush inflation and restore faith, but strangle growth, smash banks and detonate the federal budget. Or pivot, loosen policy and inject liquidity, but risk runaway inflation and destroy confidence in the dollar. Either path is disaster. The Fed's balance sheet, already swollen to $744 trillion, is groaning under pressure. In early 2025, it reported a $142 billion loss. The first time in history that the interest it paid out exceeded what it earned. If this storm intensifies, those losses will mount. Meanwhile, Congress bickers over spending caps and debt ceilings, pretending the fire isn't already burning down the house. Former Treasury official Stephen Ratner put it in one word: triage. The Fed isn't steering the future anymore. It's just trying to keep the wreck from collapsing. It's not strategy anymore. It's survival. Washington is just trying to stop the bleeding. Forced to backstop banks that can't stand on their own and bankroll a government running out of time. But even that may not be enough. The question now isn't what the Fed will do. It's whether the markets still believe the Fed matters at all. Confidence, once unshakable, is seeping away through cracks that no patch can hold. The numbers don't lie. In the first quarter, German government bonds, sleepy, dull, safe, absorbed a record $76 billion in inflows, a 41% surge year over year. Not because Germany suddenly promised higher returns, but because investors were running, fleeing volatility, fleeing the dollar, fleeing a system that feels like it's fracturing in real time. What began as a subtle tremor in the bond market has mutated into a direct challenge to US financial supremacy itself. And through it all, Beijing stays silent. The silence isn't passive, it's deafening, calculated, strategic. The exits are getting crowded, and in Washington the game has shifted. It's no longer about vision or strategy, it's about fear, perception, and a desperate race to keep the clock from hitting zero before the entire structure collapses. The center is no longer holding. In Washington, paralysis has hardened into dysfunction. In Tokyo, policymakers scramble, shielding the yen like it's wartime. The pillars of the old order are cracking. And while the West stumbles, the rest of the world is already adapting, rewriting the rules of survival in real time. The belief that US assets are untouchable, sacred, unbreakable, that belief is fading fast. Investors aren't just diversifying, they're running. And they're not running to Wall Street, they're running to Europe. Germany, once mocked as boring, has become the fortress, the last refuge in a storm that no longer feels abstract or distant. The dollar is unraveling, not in a sudden collapse, but in an erosion that feels impossible to stop. The dollar index has already slipped 3.8% since January. It's not just a number, it's a signal, a crack in the foundation. Faith is evaporating. Central banks from Brazil to Abu Dhabi are dumping dollars, not in anger but in anticipation, quietly rotating into euros and yen. They don't think those currencies are perfect. They just no longer think the dollar is inevitable. This isn't a correction, it's an exit. A slow-motion escape from a system built on US debt, US dominance, US gravity. A machine whose circuitry is now misfiring. Every day the fuse shortens, every hesitation, every contradiction, every delay pushes the world closer to an edge it may not be able to retreat from. By March 2025, dollar reserves in global holdings fell to just above 57%, the lowest in more than 30 years. The symbol of stability is now a source of instability. Once the anchor of the global economy, the dollar has become the storm. Washington still tries to steer the ship, but the wheel is slipping, the maps are outdated, and the passengers are already eyeing the lifeboats. And while Washington reacts, China builds patiently, relentlessly, ruthlessly. A new financial world is emerging, one that doesn't need the dollar at all. The digital yuan is live. Bilateral trade in local currencies is expanding, energy is priced outside of SWIFT, infrastructure, agreements, settlements, all designed to bypass the US system. This isn't theory, this isn't future talk, it's happening now in contracts signed, in pipelines financed, in code deployed. And it's bleeding into the real economy. Apple didn't negotiate exemptions for its iPhone supply chain because it wanted to. It had no choice. Over 60% of Apple's products are still assembled in China. Nearly all of its chip packaging is Chinese. When Tim Cook flew to Beijing in early 2025, it wasn't for optics, it was survival. What he told Washington wasn't diplomacy, it was a warning. Full decoupling would cost Apple over $21 billion and, honestly, shatter its entire roadmap. Decoupling isn't just policy, it's a cliff. And while corporations bend, families break. The Federal Reserve reports that 37% of Americans can't cover a $400 emergency without borrowing. Tariffs from the last trade war linger, costing households an extra $800 a year. Inflation surged again in 2024 and wages shrank. Pandemic savings, well, they dried up. Now, new tariffs loom, threatening to push prices up another 12.4% on electronics, cars, clothes, even basics. Essentials are becoming luxuries. 61% of Americans are already cutting back on everything but necessity. The trade war meant to wound Beijing is gutting Main Street, and there's just no safety net left. Inside the White House, policy is chaos. Tariffs imposed, then rolled back. China condemned, then quietly accommodated. Apple attacked, then exempted. A leaked Commerce Department memo confirms what markets already see. A government split in two. One camp demands separation, while the other warned separation would trigger collapse. The result? Well, confusion and disarray. Markets see weakness, not leadership. Quietly, almost unnoticed, things begin to change beneath the surface. It's a silent shift, subtle, but it's reshaping the landscape in ways that will soon become impossible to ignore. Trump's approval among independents has collapsed to 39%, dragged down by fear, instability, and fragility. The Conference Board's index has been in freefall for 14 straight months, screaming recession before year's end. Goldman Sachs has cut growth forecasts to 1.2%, Investment is evaporating, layoffs spread. Wisconsin, Pennsylvania, Michigan, factories hollowed out, margins destroyed by rising import costs. The comparisons to 2008 are no longer whispers, they're spoken openly. And yet, no one blinks. The election looms, the markets won't wait, the world won't wait. Interest rate tweaks won't fix this. Targeted tariffs won't fix this. These are bandages on a systemic wound. The real shift is already under construction. China's campaign to dethrone the dollar isn't a warning shot, it's an architecture project. A financial world that no longer requires Washington. Oil in yuan, commodities priced outside Western markets, digital settlements controlled by Beijing, a system where the US lever no longer moves anything. This isn't the climax, it's the prologue. The tariff battles, the reserve rotations, the drama on the news, that's just noise. The real shift is silent. It's coded into contracts, baked into pipelines, etched into agreements. It's already happening. It's not just a financial transition, it's a power realignment, and it's already